this session will look at financial liabilities in a bit more detail. In particular, I'm going over their classifications and a number of examples to illustrate the different measurement models. So for financial liabilities, they are a bit more simple than the financial assets because here we're only going to have two measurement classifications that we can use. Either amortized cost or fair value through profit and loss. Okay, so there'll be no fair value through OCI for financial liabilities. It's only one of these two classifications. Typically, your financial liabilities fall into the amortized cost classification as a default, but there is an exception to this. So you would use the amortized cost classification unless it meets the criteria to be classified as fair value through profit or loss. And it is similar classification criteria to that of your financial assets. So if it is held for trading or is acquired or incurred principally for the purpose of selling or repurchasing it in the near term. So again, this is really just focusing on the fact that, the intention ultimately behind engaging in this transaction is for a short-term purpose, for the purpose of selling, for trading, or if it's a derivative or an initial recognition as part of a portfolio of identified financial instruments that are managed together and for which there is evidence of a recent actual pattern of short-term profit making. So again, really focusing back to this notion of having the intention to sell, trade, make a profit in the short term. Must again be designated on initial recognition if you are going to be choosing the fair value through profit or loss classification for measurement. And so of these two classifications, when we're looking at financial liabilities that are classified at amortized cost, you would use your effective interest rate. And really, these types of financial liabilities are not held for trading and ultimately not designated at fair value through profit or loss and acquisition. Where as opposed to the financial liabilities that are measured at fair value through profit or loss, we know that the criteria there is ultimately that it is held for trading and it is purchased with that ultimate intention to sell or repurchase in the short term. So for a profit-making intention. Or it is designated at fair value through profit or loss on acquisition itself. When looking at the measurement of financial liabilities, so your amortized cost, similar to with your financial assets, you are going to capitalize the transaction costs to the cost of the financial liability. Now, it is important to realize that when you capitalize to an asset, you are debiting the asset, you are debiting also the asset with the transaction costs. Whereas with a financial liability, you raise the liability by crediting the financial liability, but to in fact capitalize the transaction costs, you're debiting the liability. So ultimately it is reducing that liability itself. So amortized costs is initially measured at fair value less transaction costs. Important that we understand that because it is a liability, by capitalizing the transaction costs, ultimately we are reducing the liability. And there's a nice illustration of that in our financial instruments revision workshop if you would like to watch that video as well. There's a bit of an illustration there on why we have deducted the transaction costs from the fair value when we are doing financial liabilities in terms of the amortized cost measurement model. Subsequently, it's measured using your effective interest rate. So again, very similar to what we did with financial assets. The second measurement model where we use fair value through profit or loss. Initially measured at fair value, so we're ignoring the transaction costs when we are recognizing the value of the financial liability. The transaction costs are going to be expensed. The same with fair value through profit or loss measurement model for assets. Okay, so it is treated in the same manner. It's subsequently measured at fair value, and these fair value changes and adjustments will be taken directly through profit or loss based on whether there's an increase or a decrease in the financial liability value. We're now going to look at example 21 from our Gripping Garb textbook. And this example says to us that Tempo Limited issued 150,000 10 Rand debentures on the 1st of January 20x4 at 10 Rand each. Tempo paid transaction costs of 100,000 Rand. The debentures have a coupon rate of 10% and are compulsory redeemable on 31st of December 20x7 for 12 Rand each. These debentures are classified at amortized cost. You're required to prepare the journal entries for the year ended 31st December 20x4, and we are assuming an effective interest rate of 16.32688%. So initially, if we were to apply our steps, we would want to say to ourselves, what kind of financial instrument do we have in this question? So we see that they've issued debentures. So debentures, is that going to be an equity instrument or a debt instrument? Okay, so debentures forming a part of a loan, therefore it would be a debt instrument. We'll then move on to our next step and say to ourselves, well, do we have a financial asset or financial liability? And remember, it all hinges upon from whose perspective you are looking at things. So here they've issued debentures. That then means they've given an IOU and they have received money. That then means that they're going to pay back this money in the future. Therefore, they have a financial liability. They owe money. They're going to pay back in the future. The next step is to classify this financial liability, which we were given in this question as the final sentence, to say that these debentures are classified at amortized cost. Now that we have the classification, we know that our next step will be to determine the initial amount to recognize the debentures, the financial liability. So we know that for amortized cost, we must capitalize the transaction costs, and therefore it will be determined as fair value less the transaction costs. And what was the fair value in this question? Was 150,000 debentures were issued at 10 Rand each. And that then makes a fair value of 1,500,000 Rand. And they said they paid transaction costs of 100,000 Rand, which means that 1,400,000 Rand will be the amount that we initially recognize the financial liability. We then would move on to the following step where we provide our effective interest rate table and then finally journalize. So when we are developing our effective interest rate table, we would want to start off at the 1,400,000 Rand that we determined from step 4 as being our initial measurement. We would then use our effective interest rate of 16.32688% multiplied by our opening balance of 1.4 million to get our interest of 228,576. When looking at the payment, it would be based on the issue value. So we issued 150,000 10 Rand debentures. So that then means it's at a value of 1.5 million and the coupon rate is 10%. That then means 1.5 million times 10%, the annual payment would be 150,000 Rand. We would then take our opening balance plus our interest minus our payments to get our updated closing balance. You would then continue this on for X5, X6, and X7. When we get through to our journal entries, we now want to firstly recognize our financial liability on the initial date of issue, which is the 1st of January 20x4. Debit bank, we're receiving this money of 1.5 million and we credit our debentures with 1.5 million. They then show in the following journal entry where they debit debentures with 100,000 and credit bank with 100,000 to show the capitalization of the transaction costs. Now you could have in fact amalgamated those two journals into one. You could have simply said debit bank with 1.4 million, credit financial liability debentures with 1.4 million in line with what we have developed from step 4. We now reach the end of the financial year, 31st of December 20x4, and we need to provide for 2 sets of journal entries. If we look back at our table, it would be the interest as well as the payment made. So the interest of 228,576 Rand Remember, we have a liability, so we expect to see here debit interest expense. And we then have our contra account crediting our financial liability debentures. We then move on to the next item, which would be the payments. We credit our bank with the 150,000 Rand that corresponds to our effective interest rate table and debit financial liability debentures. Now, it might be important for you to actually name your financial asset or your financial liability, because you might find entities have a number of financial liabilities. So it's important that you reference exactly which one you are referring to when you are preparing your journal entries. Looking at our next example, which is example 22, it says to us that Moose Limited issued 100,000 10% debentures on the 1st of Jan 20X5, the proceeds totaling 200,000 Rand. Moose designated these debentures to be held at fair value through profit or loss. Transaction costs incurred by Moose Limited came to a total of 1,000 Rand. Coupon interest of 20,000 Rand is paid on the 31st of December 20X5, and on the 31st of December 20X5, the debentures had a fair value of 300,000 Rand. So in our second bullet point, we were already informed that they will be designating these debentures to be held at fair value through profit or loss. So we immediately know that the transaction costs in the third bullet point will be expensed as a result of that classification. So if we were to start with our steps, do we in fact have a debt or an equity instrument? We're told in this question that we are issuing debentures. Debentures being a form of loan is a debt instrument. Do we have a financial asset or a financial liability? If we are issuing debentures, means we are getting money now that we have to pay back in the future. And we're giving an IOU. So that then means we have a financial liability. The third step, we need to classify this financial liability. We're already told that in this question, they will be classifying it at fair value through profit or loss as per our second bullet point. The fourth step, because we are using fair value through profit or loss, we know that the transaction costs are going to be expensed. So our fair value is simply the value at which they were issued for, which was 200,000 Rand as per the first bullet point. And our transaction costs of 1,000 Rand are going to be expensed. We then would need to develop our effective interest rate table, and from that table, we can then proceed with our journal entries. So starting off on the 1st of January 20X2, we want to bring through our opening balance from step 4, which is our fair value of 200,000 Rand. At the end of the financial year, we need to account for interest. And that interest would be based on directly that what was told to us in the fourth bullet point. There was coupon interest of 20,000 Rand that is paid. And then we're told payments of 20,000 Rand. Okay, so that would come also directly through from your first bullet point where we said that the proceeds is 200,000 Rand and there are 10% debentures. Okay, so 200,000 Rand times 10% is 20,000 Rand. Okay, to journalize this information, firstly, our transaction costs being expensed, debit the transaction costs of 1,000 Rand, credit bank, and then to recognize our initial recognition of the financial liability, debit bank, because we're receiving money now that we're going to pay back in the future. Credit our financial liability of 200,000 Rand. And thereafter, we can journalize our interest expense as well as the payment that is made to the debenture holders. So debit our interest expense of 20,000, credit the financial liability. So that will always be your contra account with these first two journals at the end of December 20X5 that are taken directly from that effective interest rate table. And for the payment, credit bank of 20,000 and debit, your contra account is always your financial liability. Then when we reach year end, we know that we are dealing with the classification at fair value through profit or loss. So we must account for any fair value adjustment. If we look at our books, our opening balance was 200,000 Rand. Our closing balance at the end of the year is still 200,000 Rand. But the fifth bullet point from our question told us that they had a fair value of 300,000 Rand at year end. That then means there was an increase of value of 100,000 Rand. So from 200,000 Rand in our books to the fair value of 300,000 Rand. How do we account for this additional increase in value of our financial liability? We need to credit our financial liability with 100,000 Rand, and we debit our fair value adjustment taken directly to profit or loss with 100,000 Rand. There is also variations in terms of financial assets and financial liabilities when you are looking at the settlement in the entity's own equity instruments. So basically that means you are paying for something with your company shares. So now there's two ways in which you could in fact pay for something using the company shares. Now the first scenario is a contract that will be settled with a fixed number of that company's equity instruments or shares in exchange for a fixed amount of cash or financial asset. This is deemed to be an equity instrument. The second scenario is a contract that will be settled with a variable number of shares whose values equals a fixed amount, and that would be taken as a form of financial liability. Okay, so first one is a fixed number of shares, and the second one is a variable number of shares. So that is the difference between the two scenarios that you could come across when an entity is settling in terms of their own equity instruments, or in other words, shares. So we're going to look at example 39. This example from your Gripping Garb textbook says to us that US Limited buys a machine worth 600,000 Rand on the 1st of August 20x5 from Me Limited. US Limited shares had a market price of 4 Rand on the 1st of August 20x5 and 6 Rand on the 31st of December x5. You're required to prepare journals for the following scenarios. The first scenario is where they issue a fixed number of shares in exchange for the machine. The second scenario is where they issue a variable number of shares. It's just got to equal a fixed Rand value in exchange for the machine. Okay, so just reminding ourselves, fixed number of shares, we look at it as being an equity instrument. Variable number of shares, we're going to account for that as a financial liability. So the first scenario is where they're issuing a fixed number of shares. We're treating it as an equity instrument itself. So debit the machine, 600,000 Rand, credit our share capital, deferred shares for 600,000 Rand. Okay, then at 31st of December 20x5, we can now debit our deferred shares and we credit our stated capital with 600,000 Rand to provide the issue of 120,000 shares. Okay, so this is where they are issuing those 120,000 shares at the end of 31st of December x5. Okay, in the second scenario, they issue 600,000 Rand shares. So they're issuing here shares worth 600,000 Rand. So ultimately, we've got a variable number of shares. Okay, so we debit our machine, credit our financial liability with the 600,000 Rand. How does that differ now from our first scenario? Here we are accounting for it as a financial liability. Debit our financial liability, credit the share capital with 600,000 Rand, which ultimately is actually going to work out to be 100,000 shares. Okay, so as opposed to the first scenario where we issued 120,000 shares because it was in fact a fixed number of shares, here we are issuing only 100,000 shares because we have to issue shares that are worth 600,000 Rand. So it's important to understand the difference where the issue of shares relates to a rand value, we use financial liability in terms of our journal entries, whereas if we are issuing a certain number of shares, we're ultimately going to account for that as an equity instrument, the share capital itself. Interest, dividends, gains, and losses. So if the instrument is classified as a financial asset or financial liability, you would need to recognize the interests in relation to that, any potential dividends, gains, and losses in the profit or loss. Whereas for the equity instrument, you recognize that interest, dividends, or gains and losses in equity itself. So as you can see, when we worked out these various steps, it was actually important for us to be able to determine, do we have a debt instrument or an equity instrument? And then is that instrument, in fact, a financial asset or financial liability? In terms of offsetting financial assets and financial liabilities, okay, these may not be offset against each other unless the following is satisfied. So the first criteria is that the entity has a legally enforceable right to set off the financial asset and financial liability. That right to offset mustn't be contingent on something taking place in the future, on a future event. It must be legally enforceable in all these circumstances. So during the normal, ordinary course of business, or in the event of default. So if someone doesn't fulfill their side of the deal, then it becomes enforceable, or in the event of insolvency or bankruptcy. The entity must also intend to realize the asset and settle the liability simultaneously or on a net basis. Yeah, so this is really feeding back to IS1 when we looked at offsetting, and this is really the same emphasis coming through in our financial instrument section. When looking at disclosure, what might you expect to come across? So the following figures must be separately disclosed. Firstly, the finance costs from a financial liability must be shown separately from the others in profit or loss. You also need to show your fair value adjustments that go through profit or loss separately, as well as your fair value adjustments in OCR separately. Also, any impairment loss reversal that you may have had in terms of a financial liability must all be separately disclosed. In the statement of change in equity, your gains and losses on your financial asset at fair value through OCR would have its own column. So remember, all of your items that are going through OCR would then have their own column in the statement of change in equity. Each of those columns in the statement of change in equity then has its own line in the statement of financial position. Okay, so don't forget that the flow between our financial statements and how they all relate to one another. In the notes to the financial statements, you expect to see any potential fair value gain or loss. Also, you would need to take off the tax on the fair value gain or loss, because that would be shown at a net value in terms of our statement of comprehensive income. In particular, the OCR section is shown net of tax. In the accounting policy note, your criteria for recognition. So how have you recognized your financial asset and financial liability? What have you used as a determining basis, as well as your basis of measurement? So have you used amortized cost? Have you used fair value through profit or loss, etc.? Also, in terms of your notes, what we expect to see coming through in the form of disclosure is the extent and nature. So is this a debenture? How big is the value of the debenture? Is it redeemable in 17 years' time? Okay, so all of this information would be included. Any significant terms and conditions that are attached with that financial asset and financial liability. Any movements in balances at reporting date. So you should have some form of reconciliation. Start off with your opening balance, add your interest, minus payments, show your closing balance, as well as any other details. So what is the face value? Are there 10 rand debentures? What is the date of maturity? Is it 31st December 2025? What is the interest rate that is being applied on this financial asset or financial liability? In terms of your statement of comprehensive income, we expect to see potentially dividends coming through there in the form of your profit or loss values. And remember, those adjustments would be made directly to the financial asset or financial liability. Any interest income or expense, this is particularly relevant in terms of the amortized cost method. Any fair value adjustments, remember those fair value adjustments may go through profit or loss, or they may go through other comprehensive income. You need to make sure that you show that in the correct place. And any profit or loss on sale of a financial asset, as with any other asset, that would be included within your statement of profit or loss and other comprehensive income. Just to close off our financial instruments, we're going to do a brief comparison on how financial instruments are accounted for in terms of full-blown IFRS, as opposed to IFRS for SMEs. So when looking at IFRS, your financial instruments are measured at fair value or amortized cost, whereas IFRS for SMEs, they only use two methods, fair value through profit or loss or amortized cost. So while for IFRS for financial assets, we have 4 categories, and financial liabilities, we have 2 categories. For IFRS for SMEs, it's just 2 categories, for financial assets and financial liabilities. They don't account for fair value through OCI at all. So as you can see, the IFRS for SMEs being a little bit more basic and simplified, so that it's easy in terms of implementation. For full IFRS, your fair value gains and losses are recognized in profit or loss. And for investments in equity instruments, you may designate fair value gains and losses to go through OCI. Whereas you can see for IFRS for SMEs, they don't have those complications. There are also a lot fewer disclosure requirements when you are applying IFRS for SMEs in terms of financial instruments.